So very high level, Ether Capital, we are a Toronto-based company. We've been around since April of 2018, and we're very focused on Ethereum in terms of core infrastructure and the native token. We hold over 44,000 Ether on our balance sheet, and we are staking about half of that for about a year now and generating a yield on that Ether balance. Year to date, our revenue basically equals our operating expenses. So we no longer have a heavy burn like we did before we were able to stake. And we are currently building out some tools internally and assessing what those may lead to in terms of operating businesses that we would offer to third parties and to help the industry and at that network level. Next page. So with that, I'm going to turn things over to Ian to go through the financials of our company and talk about the last quarter. Ian, you're on mute.
Sorry about that. I'll try and be quick because I think Brian's going to talk about some interesting things later on. But on Wednesday morning, we issued the financial results for the third quarter, and hopefully everyone in this call has had the opportunity to review our press release, the financial statements, and the MD&A. In today's webinar, we'll review the highlights of those documents and perhaps provide some additional insight into those numbers so everyone has a better understanding of the financial performance. Now, given the incredible volatility and change underway in the crypto market, I'm not going to start off with a summary of our financial results. Rather, I'm going to lead off with our perspective of key financial drivers of the business. And on this page is a list of 5 items that investors and prospective investors should consider when assessing our company. Now, for each of these, I'm going to spend a minute or so to provide an update on each of these factors, then aggregate them in a financial summary in about 6 minutes. So if you could switch slides. On this slide, we have a chart of Ether, the price. And as apparent from this chart, the price has been a roller coaster for the past year. Now, during Q2, we experienced the lowest price over the past year, and we ended the quarter at Canadian dollars 1,314. Now, during June and July, there were many corporate participants within the crypto ecosystem that experienced extremely difficult conditions, including some bankruptcies. Now, the Ether price seemed to hit a floor and plateau during the summer, then rebound in late Q3. So the price of Ether increased to Canadian dollars 1860, or 42% during the quarter. Now, between January 1st and September 30th of this year, different story. Ether has declined 60% in value. There's been considerable volatility in Ether price this week due to the fallout from the FTX situation. I trust everyone is familiar with that topic, although Brian will discuss his views later in the webinar. Now, we believe that the extreme volatility to be temporary, as various market participants seek to repatriate or control their tokens, sell collateral for liquidity purposes, and in some instances, speculate. Next slide. The valuation of our company is very reliant on its balance sheet assets currently. Though our external auditor has reviewed our financial information, these numbers are not audited. Now, over the quarter, we benefited from the increase in price from Ether to 1860, and this 42% price increase translated into the value of our Ether assets as summarized in this table at $83.3 million. During the third quarter, we also increased our holdings of Ether staking rewards by 241 Ether due to that staking. On a year-to-date basis, our digital assets have declined materially, though, due to the decline in Ether price. Now, on December 31st, the price of Ether was, in Canadian dollar terms, $4,676, and our digital assets were valued at over $203 million. Now, it is important to emphasize, though, that these are not realized capital losses, and there have been no sales of our Ether or staked Ether during this quarter or this year. We've only shifted some Ether assets to staked assets internally. Now, for the accountants in the audience, there's a different valuation methodology for Ether versus staked Ether and Ether rewards. And this is due to the IFRS rules, and that staked Ether and Ether rewards are currently deemed to be illiquid level 3 assets, where Ether is deemed liquid and mark to market. Next slide. One of the strategies that distinguishes Ether Capital is the ability to earn income or yield on our Ether by staking it. This is not feasible currently with ETFs that hold Ether or Bitcoin. Now, for those unfamiliar with staking, we lock up our Ether into the Ethereum staking protocol and validate new blocks on the Ethereum network, either as a block proposer or a tester. Now, for undertaking this activity, stakers earn fees. At all times, we control our staked Ether, and we are not depositing the staked Ether with a centralized counterparty. Now, at the current time, about 12% of all Ether globally has committed to staking, and more details can be found in our interim financial statements in the MD&A. Now, the company is staking approximately 46% of its Ether assets and earned a yield of approximately 4.67% in Q3, pretty similar to the 4.84 for the first 9 months of the year. We are paid in Ether, not in US dollars or C dollars, and we hold these Ether staking rewards on our balance sheet. A major development with respect to our staking yield was the merge. Again, Brian will talk about that, and that happened September 15th. When Ether transitioned from a proof of work consensus mechanism to proof of stake, incremental fees were allocated to staked Ether. For the last 2 weeks of September, after the merge, our average staking yield increased to 5.9% due to the addition of these fees, generally given the acronym MEV, or maximal extractable value. Currently, there's no market to sell these Ether staking rewards for fiat currency, but it is expected that they will be liquid after the Shanghai fork in 2023. And the Shanghai fork is the name given to a major network upgrade and is managed by the Ethereum Foundation. And Brian will address that topic later. Now, the company intends to stake more of its Ether, given it is not an active trader of its Ether assets. And within time, such staking percentage may range between 80% and 90%, subject to board approval and prevailing market conditions. If this increase in staking from 46% does occur, it should positively impact the company's revenue generation from its assets. Next slide. Another source of revenue for Ether Capital is consulting revenue with Purpose Investments. Purpose is one of the largest crypto ETF providers in the world. When Purpose launched its family of digital asset ETFs, it relied on Ether Capital to assist that launch and the continuous marketing of the ETFs. We entered into a formal agreement in early 2021, and the company shares in the management fees of those ETFs. This slide summarizes the consulting revenue earned, which is highly linked to the AUM of the Purpose crypto ETFs. The average AUM during each period is included in the table. An attractive feature of this revenue source is that it is paid in Canadian dollars and allows the company to pay for some operating expenses. Next slide. In 2018, the company considered a strategy of using its capital to invest in early-stage crypto companies. $2 million investment was made in a private US company, Wyre, which specializes in crypto to fiat currency on-ramps and off-ramps for e-commerce. Despite initially agreeing to an amalgamation with Bolt Financial in April, both parties agreed subsequently to remain independent companies and announced this decision in early September. Now, since the start of the year, there has been a material decline in business conditions and valuation of fintech companies. So we have estimated the fair market value of the Wyre investment at just over $2 million on September 30th, and that's a material reduction from the $4.175 million valuation on June 30th. Next slide. To finish my remarks on financial drivers, I end on the most popular topic of taxes. We discussed them briefly last quarter, and this table summarizes the tax situation. Essentially, we have a tax asset that is discussed in the notes in the interim financial statements. Over the years, the company has generated income tax losses that total $19 million. This year, there are 2 potential calls on the use of those tax loss carry forwards that can be applied to shield the company from potential taxes. Firstly, we may have taxable income in 2022, largely due to the capital gains on selling some non-digital core digital assets, such as Maker. And this was offset by a realized capital loss and a small operating loss year to date. In a nutshell, the estimated 0.8 million taxable income for 2022 and resultant current income tax expense can be offset and shielded by using some of the tax loss carry forwards. We would not pay any current income tax. Secondly, this is important. The fair market value of our digital assets exceeds our tax cost base by about $26 million. This difference is unrealized and will fluctuate based on the price of Ether. At this time, there's no intention of the company to sell any of its Ether assets and trigger a taxable capital gain. Regardless, we do estimate that the potential tax liability for conservatism. It is our belief that this $26 million difference would be treated as a capital gain and thus attract income tax on only half that total, or $13.1 million. To bring this all together, we have utilized our tax loss carryforwards to shield the company from any tax liability on a year-to-date basis, both current and deferred. And therefore, we'd have about $5.9 million of unutilized tax loss carryforwards. Next slide. On this page, we bring it all together. We summarize the revenue and expenses. In 2022, we've rearranged the expenses into two categories to assist the readers. Operating expenses are ones that management can control and can be applied to the revenue. The other category, non-operating and intangible expenses, reflect changes in asset valuation, such as impairments, and realized gains, losses on selling assets. These expenses are extremely large and create a considerable amount of noise to the operating performance of management. As such, the net income is very volatile, and the other comprehensive income category in the financial statements makes analysis challenging. For this reason, we believe the readers will benefit from segregating the expenses between operating and non-operating. The book value of the equity has increased to $2.62 per share from $1.96 on June 30th, largely due to the increase in Ether price. On a year-to-date basis, the opposite is true due to the 60% decline in Ether price. As a reminder, these numbers have been reviewed by our external auditor, but are not audited. Next slide. This slide summarizes three implications for investors. Firstly, we're emphasizing that revenue less operating expenses was break-even year-to-date. Compared to an ETF that holds Ether, we do not have the expense drag of an MER. Secondly, the company intends to increase the amount of Ether that is staked now that the merge has been successful. No decision has been made on the amount of Ether or the timing yet. And thirdly, we anticipate that operating expenses will be higher on a go-forward basis. Staff levels have increased, and the company is assessing the feasibility of bringing certain functions in-house and launching a new operating business. Again, no decisions or commitments have been made. Next slide. On this slide, we summarize our assets. The audience should note that our Ether staking rewards balance grows every day. In total, the company owns over 44,800 Ether as of September 30th. Next slide. Our share price has suffered this year with the decline in Ether price. On this chart, we also include the price of Ether over the period to illustrate the high degree of correlation with our share price. Thus, the price of Ether seems to be the major determinant of our share price performance. As well, the current price and discount likely reflects the incredible instability gripping the crypto market with the collapse of FTX and the resultant contagion. Next slide. For those on the call, we'd like to share with you some of management's efforts to inform both current and prospective investors and to attract liquidity for the company's shares. Firstly, we have a dedicated market maker, an independent firm that trades the stock and seeks to minimize disruptions and maintain a competitive bid-ask spread for trading. Management has discussions with our market maker frequently and receives periodic reports on trading activity. Secondly, the company has employed a specialist firm that engages with investment advisors across North America to communicate our story. Since March, they have contacted over 8,000 advisors in a daily structured campaign. With respect to our communication strategy, we have preferred to issue press releases only when we have something material to disclose, rather than issuing frequently in order to garner attention. Our market positioning for investors is summarized on this slide. 1, 94% of our book value is Ether. Our valuation is highly correlated to the Ether price. 2, we are not just passive holders of Ether, we can earn a yield. Such yield varies daily and has been above 4.5% this year. After the merge, it increased to 5.9%. 3, holding Ether capital, we believe, is a better value proposition than holding an Ether ETF, which we will summarize in the next slide. And finally, Ether capital believes that it may be able to build some new operating businesses with its financial resources that will increase enterprise value. Such new operating businesses are being assessed internally and have yet to be disclosed. They will take advantage of the current intellectual property and professional networks of the team. Next slide. And this is my final slide. And it really provides an easy comparison between owning Ether capital shares or units in an Ether ETF. In our opinion, it puts forward 4 compelling reasons why we believe that Ether Capital is a more appealing investment. Our company can generate revenue and provide a yield on its assets. Our shares have been trading at a discount to the theoretical book value per share. Investors would also have upside to future operating businesses and earnings with the underpinning of a strong, unlevered capital base, something that ETFs cannot do. With that, I'd like to turn it over to Brian.
Thanks for that, Ian. And now going to talk a little bit about the current market conditions. Asha, if you can just go to the next slide. So, of course, the big news that is emerging in the last few days is that FTX, the world's second biggest exchange, has become insolvent and now filed for bankruptcy as of this morning. Important to know that there's a lot of rumors circulating. There's potentially a lot of related businesses or businesses that were lending out assets or tied up somehow with FTX or a related entity called Alameda Research. And so the space is currently feeling a fair amount of turmoil. And this is a very ongoing story. It's rapidly evolving. If anyone is following the story on Twitter or in the news, you can see that every 6 hours, there seems to be new details that emerge. What this does mean, though, is potentially, investors are spooked from the market. This was a very highly trusted exchange, had a very high profile. It was working with regulators on what an appropriate framework should look like for crypto in the US and also up in Canada. And so it is possible that we will see the ripple effects of this for months and potentially years. If I can share my own experience in the space, I joined in late 2012, early 2013. And at the time, the world's biggest exchange was called Mt. Gox. And that also became insolvent with the theft of a few $100 million in Bitcoin, which doesn't seem very material by today's standards. But at the time, this was the world's biggest exchange, and it did erode a lot of confidence. And it took a number of years to build back that investor base and to have retail investors come back to the table. That said, though, the space didn't go away. The space continued to say, how do we get better from this? How do we build more institution-grade products? How do we force transparency into custody solutions, into retail-facing exchanges? And I think that will happen here. I believe that will take time, but I'm confident that the space will emerge better from this, despite the short-term pain. This will speed up regulation and likely cause there to be additional oversight on these crypto trading platforms. And it's also important to remember that FTX had two different, there's a number of entities, but the main issue here is FTX International versus FTX US. And so the local exchanges, we'll see how this plays out. But this is why I think we need regulation in a local jurisdiction on how do you be compliant? Because if you don't, you end up sending retail investors or institutional investors to a foreign platform that may not have the same set of standards as in our jurisdiction here in Canada. If we can go to the next slide. Of course, this was a big story in early September. The merge, we have been talking about it for years. It was a really exciting moment for Ethereum, where we turned off proof of work mining, the need for electricity and computing hardware to validate the network, and instead replace it with proof of stake, which allows ETH holders to lock up their ETH into effectively a bond with the protocol and generate a yield and clip a portion of the transaction fees of all the activity happening on the network and get a base fee as part of the inflation schedule of ETH. This was a really important moment for Ethereum. It has been years in the making. People doubted that it would ever come to fruition and that it would just further get delayed, or perhaps there'd be a technical issue during that transition, but it was pulled off seamlessly. It was quite actually a boring event to watch live because nothing happened other than it was successful. And that really was the best case scenario where the engine changed from under the hood and there was no disruption to the network. And I think that this frames, and including this FTX news and everything happening in crypto, that we're seeing a pullback from the new flavor of the month assets or flavor of the month protocols, and a refocusing towards what are the core assets that are likely to be around in the next 5 years. And to me, that is going to be Bitcoin and Ethereum. They're going to be important assets. What the price will be, of course, no one knows. But I think that the merge sets the stage for confidence that the Ethereum team can deliver. They can upgrade this network, and they can build a more robust and scalable network and roll out these upgrades and hit timelines, even if they are slightly delayed. The important thing is that they get them right. So this was a really big moment in Ethereum. A lot of people celebrated it, and it's very exciting. And that took place mid-September. Next slide. Just very quickly, I wanted to put this here because people talk about, well, Bitcoin has this hard cap of 21 million. Ethereum doesn't have a hard cap. There are some different dynamics to the monetary policy. But based on the number of transaction fees taking place on the network at any point in time, it's possible that ETH becomes a deflationary asset, which is actually what happened just recently, where the total supply is dropping below, or the new supply is dropping below a certain percentage, and Bitcoin has a 1.7% inflation rate. And so this is why it's important that even though Ethereum doesn't have a hard cap, it is possible that the inflation schedule changes, the monetary policy is flexible. And we have the second point here that shows that there's been a small amount of ETH that has been essentially deleted from the network since the merge. But if we hadn't done that switch from proof of work to proof of stake, there would have been an additional 675,000 ETH, about $1 billion, that would have been pushed into the circulating supply. So long term, this can be an important catalyst for upwards pressure on the price of Ether. And we're pulling these stats from a website called ultrasound.money. So if anyone wants to follow this along, I highly recommend you pull that up on a browser, you bookmark it, you check it every day. These are real-time stats based on what's happening on the network. Next slide. Staking yields. Ian spoke to most of this, so I don't think we need to talk too much about this. But post-merge, the yields have increased. It was about just over 4% before the merge took place, and now they're hovering between 5.5% and 6%. And again, this is a function surrounding how many people are currently staking, how many people are, or what transaction fees are being paid on the network at any point in time. And so there's a few different things that will make this yield change, and it changes constantly, but currently we've seen higher yields post-merge now that the transaction fees are taking place on this new network. So this is very exciting. It is possible, though, that more ETH becomes staked in the coming months. A lot of ETH, we believe, was held back because they weren't sure if the merge would be successful or when it would take place. Now that that event has happened, more people may look to stake their ETH. But there is one thing, which is the liquidity on that ETH. The next slide. Is around the future upgrade called the Shanghai fork. And this is around liquidity relating to that ETH. Currently, there is no ability to unstake that ETH. So if you wanted to sell it, if you needed to, that is not possible today. But this will come in a future upgrade that hopefully happens in the first half of 2023. But when people say, when do you think it'll be? I'm quick to remind them that it will happen when the developers feel technically there won't be any glitches and that the upgrade is appropriate to push out. So it could happen later in 2023. Ether Capital, though, does not need access to our staked ETH. So this isn't an issue for us, but it may play into additional institutional capital or retail investors that are considering staking. That will be an important catalyst or thing for them to consider when they're weighing if it's appropriate for them to stake or not. Next slide. So things for Ether Capital shareholders. What are some things that we really wanted to point out? I've already talked about the recent events in crypto, the biggest, of course, being the Ethereum merge, and then the current ongoing story of FTX and their insolvency. Ether Capital does not use any third-party custodian. We've had a number of people reach out to us and ask, are we somehow tied to the FTX situation? Do we hold any ETH on any of these exchanges? And we do not, and we haven't since day one. Since 2018, when the company was put together, we run an internal multi-sig wallet, meaning a number of the directors are responsible for the custody of this Ether, and there's ways that we do backups and ensure that we are a best-in-class solution, but we don't rely on any third party, and so we don't have any exchange risk. relating to where our assets are held. And that has been since day one. And we will continue to believe that that is the best solution for our shareholders and our asset base. We are moving towards liquidity on that staked Ether sometime after the merge. Again, it will happen hopefully sometime in early or mid 2023. But at this point, we have no ability to sell off that staked Ether. And we are, I think, one of the only access points in the capital markets for the ETH exposure plus staking. We know other institutions are interested in doing this. Perhaps other listed entities would like to stake. It is still a very complex thing to do. Technically, how you go through the audit process and financial reporting. These are things that we are very much at the frontier of and leading, but we don't think that there is a number of other players yet. So we remain one of the leaders in that category. And we are, of course, considering when it's appropriate to stake additional Ether. We were waiting for the merge to take place, and it would be great if we knew when the liquidity event would be to make us more comfortable with getting closer to maybe a 75 or 80, 90% portion of our balance sheet staked, but we're not there yet. So, of course, we will keep the market updated as we feel it's appropriate for us to do so. And then we continue to develop software internally around core infrastructure, things for internal needs to monitor some of our staking operations. And we are assessing when or if it will be appropriate to offer those products to third parties. But at this point, we have not done so, but we look forward to updating the market in due course. With that, I'm going to turn it back to Ashley for if there's any questions in. We don't have too many more minutes yet, but happy to answer anything that's coming in.
Okay. So we have, hi team, congrats on the successful merge and nice to witness the deflationary effects of the ETH token unfold. Ether Capital's thesis was correct yet again. Number one, as reported, there was a spike in staking yields following the activation of proof of stake. Can you confirm whether you're earning yield from both transaction fee tips and miner and MEV? What's the process of activating yield generation from MEV as a validator? If yield from MEV is currently not being generated, are there plans for the future? And that's the first question.
So I maybe tip the number and then you and the mechanics, just to confirm that, yes, that yield that we've mentioned of 5.9% post-merge includes MEV. Over to you, Brian.
There's not too much else to add. What we can confirm is that, yes, our validators are getting the maximum extractable value. And so we're not leaving anything on the table. So we are collecting as much as we can in terms of transaction fees, and we will continue to do so as long as we believe that it is appropriate.
Okay, and the second part of the question, looking ahead at the next bull run, what protocol or protocols is the team most excited about? Could we potentially see investment made to an Ethereum-based protocol in the DeFi NFT space as was done for the MakerDAO investment in 2019?
So, of course, we don't know when the next bull run will be. I will say that at the current moment, we are not looking at other protocols. We are not considering divesting that Ether balance into other layer ones. We do think that other layer twos are very interesting, things that are complementary to Ethereum, things that would help scalability towards Ethereum. We don't have any intention to focus on investments in the DeFi or NFT space. We think that those verticals are very interesting, but for other entities to focus on, we are very excited about just that base layer infrastructure focused around Ethereum. And as I was saying before, we think that what's happening in the market currently is going to refocus investors' attention back towards Ethereum and Bitcoin and away from speculative assets and other verticals. So for now, it's really all about Ethereum.
Okay, great. And I think we have one final question. Given the decline in the price of ETH, is the company considering raising capital to buy more ETH?
I'll talk just quickly to this and then turn it over to Ian. At this time, it's something that we will consider and will discuss, but we are not in need of raising any additional funds, and we'll only do so if it's not dilutive to our shareholders or minimally dilutive. And because we don't need the capital at this point, I don't think that there's anything imminent or on the horizon. We'll do it if we feel that it is appropriate, but it is something that we will consider. Ian?
Nothing to add, Brian. That's pretty good and succinct. It's good.
Okay, and I think we're a little over time here. So any follow-up questions, feel free to email me at ashley@ethcap.co. I can get those answered for you. And have a great weekend, everyone. Thank you.
Thank you for joining, everyone.